Australia's stock market 3 weeks ago, as Ed was saying, was flying. It hit a record all-time high. The S&P ASX 200 close to 8,000. It was in sight. Since then, it's down 3.6%, though it is 12.5% higher than its lows in November net last year. So what to do now? Sit on your hands or wade in and catch the next wave? Adam Dawes is a senior investment advisor at Shaw & Partners and joins me. Adam?
Yeah, great to be here.
Which one of those is it? Wade in or hold back and wait? What's the story?
I think the market got a little bit ahead of itself with pricing in one interest rate cut here in Australia. And then the US market, remember last year, they were talking about 6 interest rate cuts this year. Now they're talking about 3. Now they're washing that out, maybe 2, maybe not.
So is it true to say that if you really wanted to get the best of the market, that market performance, the record performance, you really had to have the Commonwealth Bank and you really had to have some tech shares in your portfolio, next DC or one of the other big tech shares?
Correct. Or even overseas as well, getting some overseas shares. So, yeah, definitely the banks have performed fantastically over the last sort of 3 months or so. Tech, definitely you need to have that in the portfolio. But this next wave, I think, yes, you could start getting in at the moment. I still feel that the market's got a little bit ahead of itself. And if there is talk, and this will come through in August, if there's talk of no interest rate cut, the market will then consolidate after our reporting season.
Because the interesting thing was during that period when the market had its big run-up, iron ore prices were going backwards below $100 a tonne. So Rio, Fortescue and BHP, some of the market leaders, did not contribute to it one iota.
Yeah, so now iron ore's back up to 110. It's now looking okay. We saw the GDP numbers from China coming out yesterday, a lot stronger than expected. So sometimes good news is bad news for us in our market. But yeah, next wave, I'd wait till see this market pull back 7.5, 7.2, somewhere around there. You might get some more value in it, but always look for quality companies. High ROE, so high return on equity, and low debt. There's some fantastic metrics to.
Okay, so that's the likes of the CSLs, the Cochlears. These are the types of tech-based companies that do pretty well during those times.
Yeah, which make revenue, which is fantastic.
That's right.
And they have a great return on equity.
Okay, so then you sit there and you go, right, the market could ease back a little bit from here. But as I say, the one thing that drove the market up was the tech shares.
Yes.
They're a bit more unpredictable. They're not the ones with the cash flow. They're the ones with the future promises. But you sense that something's coming even in that space here in Australia.
Well, I think the AI hasn't been quantified, and I think all of that kind of stuff just has not been put into a lot of the share price. We saw NextDC raising $1.1 billion. If you go back 5 years, NextDC's market cap was 1.1. Now they're raising $1.1 billion, right? So the growth in the tech sector has been absolutely phenomenal.
Okay, but then there's something else. The height of the interest rates has kept really, if you like, economic growth subdued.
Yes.
Therefore, you'd reckon that maybe profits are going to be down a little bit, and yet everything you sort of sense at the moment is in many sectors the profits are going to be pretty good.
I think profits are going to be great. This reporting says we're seeing the quarterlies coming out now, so we're getting a little bit of a confession session or an understanding of what's going on. I think that this time, coming into the June end of financial year, I think earnings are going to be very, very good, and I think we'll be pleasantly surprised to the upside. If we do have a pullback, it will be very shallow because a lot of people have missed out on the original last 3 months, last 6 months. So if any decent pullback, you will see fresh money coming into it, which means that the dip will be shallow as such.
And it's interesting because there's also a bit of restructuring. There's a few takeovers sitting out there. So there's actually a lot of drivers for this stock market at the moment, well ahead of any sort of rationale about the economy picking up and sort of having a 3% annual growth rate like it is in America.
Rational? Why should we be rational in the market? No, you're right. There's lots of takeovers. There's lots of exuberance. There's excitement that's out there going forward. We're losing a lot of companies, but I think, overall, we're starting to see some of these smaller companies starting to come through as well. But what we really need to see is steady government policy, which will then allow businesses to be able to say, we can do this and then project that to the market. Market gets comfortable, and then that's how share prices start to move higher.
Adam Dawes, always good to have on the program. Many thanks for your time today.
Thanks.
We'll chat again soon.
Thank you.